Welcome back to the channel, guys. I just wanted to talk a lot around the reinvestment dilemma with these income funds. Obviously, we've got the allure of these high yields, 50% plus, but obviously that doesn't tell you the whole story around total returns that we've been talking around a lot on this channel and on some of the live streams in the past. And I just want to talk about, just understanding the concepts of the NAV in the first instance. So the net asset value, is the per share value of the fund's assets. It's behavioral and key to understand for true total return. So imagine before a distribution, the fund had a stable NAV per share before it paid out its monthly income of $20. The distribution is a transfer of capital from the fund to you. So the NAV mechanically drops by the exact amount. And this is normal NAV decline, okay? The $1 comes to you, the new NAV is lower. If the fund's asset doesn't grow enough to cover the payout, the NAV is permanently impaired down to $19. And it might not grow because the underlying is flat or gone down, or no new money has come in but the fund. Or, of course, they're not making the income to offset that yet, which will happen over the period of the month. Another thing to think about is the leaky bucket scenario and the ROC. Now, I don't want to be careful when we talk about ROC because there's the true NAV decay in the fund when the fund value drops from a structural reason perspective, and you have compared the total returns to the distribution. So how do strategies lose value? So cover call risk. Obviously, you've got the downside loss. You own a stock at $100, you sell a call for $2. The stock falls to $95, your net loss is $3 overall. There's also the opportunity cost loss, which is as the stock rises to $120, your gain is capped at $7, so you miss out on the remaining $13 of profit. Now, that's harder to visualize because you've got to be monitoring the underlying and comparing the performance to be able to see those losses. What about from a put right perspective? Obviously, you've got the downside loss. So selling a put at an $100 stock with $95 strike price for $2, the stock falls to $90, your net loss is $3. Okay. When we talk about ROC from a good and a bad perspective, because it often gets misscrewed a little bit in terms of how ROC is interpreted. And there is almost good ROC and bad ROC to a degree. So scenario A, good ROC, which have tax deferral, your total return is still positive at 15%. The distribution yield is less at 12%. So the fund has earned more than it's paid out, and the ROC is a tax benefit. So this is where they could lose on a trade but still make income, and that could offset that. Scenario B is where you've got bad return of capital or capital erosion. This is where your total return is, let's say, 8%, but the distribution yield is above that at, let's say, 12%. So the fund is, in effect, genuinely returning your own money. So there's that 4% difference in NAV decay. So I just want to call that out because I know a lot of people kind of misunderstand return of capital a little bit. In terms of the kind of hybrid solution, pairing income with growth, a robust kind of strategy is to pair your income ETF with a separate growth investment like QQQ or VU in the US to kind of offset that sort of NAV decline. So you've got an income engine, and that could be generating high cash flow. That may suffer from NAV decline. So those are the YieldMaxes, the Global X's, the income shares, so the QYLDs and the JEPIs, etc. And then you've got your growth engines, and these are typical things that appreciate value, replenish the principal lost by the income fund. And these could be the indexes like SPY, QQQ, etc. So this gives you that sort of powerful option. So strategy one is to maximize your income. Take 100% of your distributions as cash. The growth engine works and keep your portfolio value stable. And then strategy number two is maximize the growth, reinvest 100% of distributions to aggressively compound those shares, creating two kind of sources of growth. Again, it's a balancing act. So when we look at this from the strategic choice around compounding income versus building wealth, and I think this is where a lot of people also get confused. They just presume that these income generators will create wealth, and they don't always create wealth. They create income for sure, and that's what they're designed to do. But because of all the capping, there isn't a free lunch out there, and ultimately, in the long term, it depends on what your goals are. And again, you need to bear in mind what you're trying to achieve with each of the investments that you're making. So a declining NAV means smaller future payments per share potentially. So do you reinvest to protect your future income from the asset, or do you take the cash to build wealth elsewhere? An example of where the yield on cost trap might occur is, year one, you invest $2,000, you buy 100 shares at $20. The fund pays you $2.40 per share. Your NAV is $20. Your income is $240 and your yield on cost is 12%. Year two, the NAV sort of declines. Your fund pays you $2.20 now. The NAV drops to $18. Your income is to $20 and your yield on cost is $11. So it fell. So your choice depends on your primary goals, as I said earlier, income for this ETF or total portfolio growth. Some of the different paths you can take, right? Option A is you want to maximize your wealth, take 100% cash. Income may decline, but cash is free to invest in growth assets from a potential higher total return. And I've used the word potential there because that's not always the case, but it can be. Partial reinvestment, so taking some cash, a compromise that sort of slows your income decline while still providing some cash for other uses. So this could be putting it in growth again, or it could be using it for expenses. Path number C, maintaining income. So reinvest to keep the shares growing. So it aims to keep the dollar value of your distribution stable by offsetting that NAV decline. And that gives you that income stability. And then finally, the maximizing compound, which is reinvesting 100%, grows your share count aggressively, leading to that highest future income from the specific asset and is focused around income growth. Now, interestingly, I did look at some back testing of some of this stuff. And what was interesting is that if you reinvested 100% of your investments in some of these, you'd actually be worse off than if you just kept the cash in cash, even if you didn't put in anything else. So there is some kind of balancing act there going on that, the more aggressive it seems the yield is, the kind of more worse off that you seem to be if you put 100% back in. And I think that some of that's just to do with the pure volatility of it. And when you buy in, you could buy in at a good time or a bad time when you reinvest back in. And so for me, when I reinvest, I'm almost looking at the underlying a little bit to say, is the underlying at a discount? Because if the underlying's dropped, the fund itself will drop to retrospectively reflect that. And then that I'm buying at a bit more of a discount than if you were just buying on, let's say, an X-date drop, as an example. There are different approaches. There's one around growth, there's one around the hybrid approach, there's one around income stability, and then one around income growth. I would say option C, income stability, is really hard to achieve because it's really hard with all the moving parts, with the underlying moving, with other things moving within the fund, the time delays between the US market opening and the UK market timings, etc. It's really hard to get that income stability approach with the volatility on top of that as well. So I think option C is really hard to achieve. It's probably the one that everyone wants to try and achieve, but it's probably the hardest one out there. Personally, I like option B and D where I'm currently at, but it depends on where you are in line and what you're trying to achieve. That's just my personal opinion. I like strategy B and D, and it just depends on what's happening in the markets and that particular fund, and my view on that, and whether I will take some partial investment or I would maximize the compounding. I'd love to do C and D, but I know from a reality perspective that's really hard to do at this stage. It might get easier over time. I don't know. With all the market conditions and all the other things I just mentioned earlier, I think that's quite hard to achieve. Okay, if we start to look at it from a tax perspective now, yield doesn't always equal total return, and people need to keep this in the back of their mind. A high yield can mask almost a falling net asset value, and that could lead to a total negative return. And this is something really important to keep in the back of your mind when you're investing in these. Also, there is an argument that eventually you will get your principal back, and then there's this concept of being on house money, which again I get for a lot of people. They may say, okay, if I just keep holding it, keep yielding. But what you've got to realize is that time to get your money back isn't static. So that yield of 50%, that yield on cost that we looked at earlier, that could change over time, which pushes that time horizon out. And you could have been better putting your money somewhere else. And so these are all things to bear in mind. From a sort of overall kind of strategy perspective, from a fund perspective, obviously they all have different ways of carrying out their strategies, and that can also impact the risk profile, personally speaking. YieldMax's synthetics mean there is slightly more aggressiveness in the NAV decay versus the NAV preservation focus, but their focus is income. Same with income shares. A lot of them are waking up to the fact that retail investors are finding this quite hard to swallow, this concept of total return and NAV decay and return of capital. And so they are trying to change their strategies a little bit to make it a little bit easier either to understand or to preserve the NAV. QYLD, which is very passive, is still going to receive NAV decay risk just because of the nature of it being really passive. They're not going to keep an eye on the markets and account for big drops and big swings, etc. And therefore, the NAV preservation is quite a lot harder for them. Although they did change their strategy slightly, where they kept 2/3 back in, reinvested it automatically in the fund, and distributed 1/3. So with that type of fund, I'm more happy to keep my entire kind of principal from there and not reinvest, because ultimately, they're doing that reinvestment back in to stabilize the NAV from a fund perspective. However, the income may not always offset the NAV decline. And if I want to obviously compound my income, then I do need to obviously reinvest a little bit back in. And then I got these hybrid approaches like the JEPIs, which try to do a lot more around the NAV preservation, but ultimately the income is going to take a hit there for that reason. Okay, the tax situation is obviously quite interesting for the, when we look at it from a US investor perspective. They need to be careful of the JEPIs and the JEPQs typically. Obviously, everything I'm talking about today is not obviously tax advice, but get the relevant advice. But it's just to give you a very higher level overview of my opinion. The distribution characteristics of them are primarily around ordinary income for ELN based, so equity linked note based things like JEPI and JEPQ. From a tax perspective, it's not very efficient for them. Index options like QYLD, SPYI, they've got some gains in there and some return of capital, so it can be moderately efficient. The reason why people like the synthetic single stocks like YieldMax is they do predominantly do return of capital, which can then be tax deferred. What about for people live outside the US, UK and EU as examples? Obviously, the first part is the US withholding tax. The IRS withholds tax before money leaves the US itself. This default rate is around 30%, but with a W8BN form, this kind of reduces it to 15% under tax treaties. And there's obviously the local taxation. So you owe tax in your home country on the income you receive. So you've got to think about the reporting status, the local tax treatments, the tax credits, the return of capital, and how it works within your region. Obviously, there's ways to avoid some of this, putting it into tax wrappers, certainly in the UK, like an ISA or a SIP. But again, make sure you do research for your own location. Okay, let's start to wrap this up now. So what's the final verdict here? The yield of illusion versus the total returns reality. And people need to focus on the total returns as an investor and not get distracted or tempted by the yield. The core principle for maximizing wealth is still reinvesting for growth. So for accumulators, reinvesting 100% is not a non-negotiable to combat that kind of drag and that compounding aspect to it. Put right strategies are, in my opinion, structurally better for total returns as they don't cap the upside. And with income shares, we've also got that 25% left alone to get the full downside, but also still benefit from the full upside, should anything win. In terms of the role of derivative income for your portfolio, so for income seekers, these are powerful cash flow tools, right? Prioritizing NAV preservation funds like JEPI or using disciplined reinvestment plan and protect your income. For total return investors, these are specialized tactical tools, not core holdings typically, using them during flat volatile markets and committing to reinvesting 100%. So again, guys, do all your own research, and this was just for education information purposes. Let me know your thoughts in the comments, by the way. Let me know which path you're looking to take as well. Be interested to see where the community is going with this and what their thoughts are. Okay, guys, hopefully this was a good one. I will catch you on the next one.